This is the Traders Exclusive Live Trader Showcase. I'm Sherry. This is the quarterly event where we feature expert traders and bring you training and insights from 20 expert traders. We have prize giveaways for everyone in attendance. We're going to do some drawings. We have some surprise interviews. Please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. This is also where you're going to find the recordings for this event. And before we get started, we have to share a quick disclaimer. You know it. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not necessarily indicative of future results. This is training. You have to do your own research, and you should always verify and research. Yes, I believe our speaker is here. Let's get him in here so you don't have to listen to Froggy Throat anymore. Thomas. Tell me if I'm saying your last name right. Is it Thomas Aspray? And you'll need to unmute yourself.
Yeah, that's perfect.
Awesome. Thomas is with Viper Reports, and he's talking to us about buy, sell, or hold. And he has got a huge history, but I'm only going to tell you a little bit. He's the chief analyst of Wentworth Research and Consulting and the editor of Viper Hot Stocks and the Viper ETF Reports. He's been analyzing and advising institutions and investors on the financial markets since the early 1980s. From his extensive biochemistry research using computers in the late 70s, he envisioned the potential for applying his research techniques to the financial markets. And through rigorous and methodical analysis, Tom developed his unique methods of computerized technical analysis. So these methods have been taught to financial professionals all around the world, and he's going to share some of those methods with you today.
Thank you very much for putting this all together. Sherry was kind enough to share the first part of my background, so you got to know a little bit about it. When I was doing protein analysis using a computer, basic metabolic protein in all forms of life, essentially, and then I was interested in the financial markets and started inputting manually data from Barron's. Back in those days, home computers were not very common, and I was fortunate enough to change careers and get a job as the director of research for a financial company who had one of the earliest forms of computer technical analysis software called CompuTrack. And you may find it hard to believe, but even like 40 some odd years later, they had the majority of the studies you may be familiar with. And, anything from, percent R to, all these tools that were, really developed, like I became good friends with Jerry Appel, who developed the MACD. And, that was on it. I went on to modify the MACD into the histogram version. So in any case, that's how I started out, and I developed my own routine, if you will, to analyze the markets and analyze indicators, more as charts than indicators. No one was really doing that, and I started using moving averages over it, as we'll discuss today. So today's presentation, I want to show you some of my favorite technical tools. Some you were familiar with, may be not familiar with the other ones, on when to decide when to buy, sell, or hold. As Sherry mentioned, I've taught traders all over the world, and oftentimes, being out of the market does not seem to be a position for them. When you're doing, working with money managers or currency traders, overseas, they always have to be in the game. So that's a little more problematic. But oftentimes being out is the best position you can have. So, risk obviously is the main determinant, in my view, of success or failure in the financial markets. So you don't want to be this guy. I'm pretty much risk adverse. For any number of years, I went to Las Vegas at least once or twice a year to speak at a presentation or seminar, and I'm not a gambler. And the only time I ever gambled was if I was in line up to get on the plane to go home. Then I would, if I had quarters, I'd play the slot machines. But that was pretty much my exposure. This is about as risky as I get. Fortunately, to able to take some time off after a long year just before COVID and visit Ireland. And I did take this picture leaning over this cliff, and my wife was not too thrilled, but I'm still here, so that's a good thing. So today I'd like to talk about a couple of methods. One is the Stark band analysis. Probably may have heard Stark bands, probably not used them. They're not available in all platforms, but I'll show you how you can approximate them. Then breadth analysis, how that gives you a whole different view of the market than any other data point that I've come across. And thirdly, we'll look at the entry and exit techniques using the pivots along with the Stark bands to determine when, okay, it's a good time to buy in terms of your risk, or it's a good time to sell in terms of your risk, and developing price targets. When I started out, I used to read a gentleman named Stan Weinstein, who still writes about the markets, and wrote the Professional Tape Reader. And his concept was the weight of the evidence, which is what I do also, is looking at a number of factors, and when they all line up, and then the risk analysis also lines up, then it's a reasonable trade. Oftentimes I'll see a market, I think it's going up or down, but the risk management is just not there. And in that case, I won't trade that market. At the end of the presentation, I'll share some of my current slides as of yesterday's close, and also obviously take your questions. So let's get started. Stark bands, basic formula developed by Manning Stoller, an old friend of mine who had the pleasure of traveling overseas with him many times. They were developing in the late 80s, right around the time John Bollinger was developing his Bollinger bands. John's another old friend, and I like the Bollinger bands, but for me, it's everyone's unique to a certain extent. The Stoller bands, Stark bands, give me much more information. And so the Stoller average range channel, very simple formula. For the Stark Plus, that's the upper band. You take a 6-period moving average, and then to that, you add twice the 15-period average true range. And then for the lower band, you subtract 2 times the 15-period average true range. Average true range was developed by Wells Wilder, created lots of great technical tools, spoken to a couple of times, and quite a mind, and he was always coming up with interesting things. So it's different than the Bollinger Bands, of course, uses standard deviation. So why are they valuable? Well, here's a long old chart of gold, and that I actually wrote about at the time. I'll show you later. I contribute to Forbes.com, and I came up, so these green lines here, this is the plus Stark band, the minus Stark band. So Manny determined that about 92% of the price activity should fall within these bands. As you can see, in this case, it doesn't always. And just because you're above, the band or below the band doesn't mean the market has to, reverse course immediately, but oftentimes it will. And as we'll look through some charts, you'll see that there's typically 2, reactions after you've been outside the bands. Either you move sideways or you reverse. So this is a monthly chart. Gold had a tremendous run in the summer of 2011. So made a new high here in August, didn't close, on the highs, as you can tell by this candle. But then in September, retested those highs. You can see these long tails. It's something I teach are very important. Looking at those, that's part of the weight of the evidence. So if you're looking to buy and you see a long tails down below, and you have other reasons for thinking this market is bottoming out, those help support your case. So monthly chart. So we were up around 1900. By the middle of next year, we were down to about under 1550 or so, and then in 2013, down below the bands here a couple of times, into the 1200 area. Also on the chart, this is a 20-period exponential moving average, in this case monthly. It's one of the only moving averages that I typically plot on my charts. I mean, I've gotten that question, so many times over the years, but to me, visually, it tells me a lot of information. So when I look particularly at the slope of that, so if you see a 20-period exponential, so monthly, weekly, daily, of course, the longer the time frame of your data, the more reliable it is, less noise rather. So if you look at, a 15-minute bar of something, that's 15 minutes worth of trades. So that's depending whether it's an active period, it may be giving you a clear picture of the market or may not. Daily, a lot more data goes into that point. Weekly, much more data, and then monthly, etc. So I look at longer term data and then sort of drill down. So when you see the 20-period moving average rising at just about 35%, one thing, this is not a market to short. We had a nice sharp drop. So yeah, for a short-term trader, we had 1 month up, we had like 5 months up, and then 1 month down, and then back up. So it tells me that if I'm not in the market and that it's not a time to be a seller. Conversely, when it's declining at this rate, like most of the markets were, as we'll show, in last year, then it's too early to look for a bottom. You can look for a rebound back to that 20-period exponential moving average, and that's often a really good representation of either support or resistance. So this moves outside a monthly band. Obviously, it took 8 years to get back to that high. So I look at a combination of levels. Looking at stock charts. So this is Netflix. Summer of 2017 was pretty strong uptrend here, and of course had earnings. So it really popped the next day, as is often the case with Netflix. Well above, opened above the Stark band, traded above the Stark band for the next 2 days. Typically, in my experience, if you see 4 or 5 bars up above the Stark band, that you're likely not going to run out of steam pretty soon, right? And of course, then you look at each week, the bands are projected for the week ahead. So, they were also above the weekly Stark band here at this 0.3. And, so when this chart ends, right on the 20 period, the parameters were 197.57 or 155.7. That's for the next week's action. So what I typically do, if you get above the Stark band for like 2 bars in a row, if I'm long, I'll take off at least half of the position, or start to use a much trailing stop, a tighter one on the remaining position. Often in a strong market, you'll see a number of cycles. Amazon, of course, same time period was quite strong. So here at 0.1, we got down near the lower Stark band, had a dramatic rally. So if you looked at that, 4 or 5 days, you probably would have been out early here. Manny developed the Stark bands to help him avoid chasing a market either up or down. I think we've all been in the situation where we think, oh, XYZ is going to move up, and then finally has a good up day, and then has another good up day, and a third up day, and then the fourth up day, you're kind of kicking yourself and thinking you should not wait for the pullback and buy. So the Stark bands can help you tell you that, well, okay, I know I'm going to get a better entry, maybe not a lower price entry, but a better in terms of risk, because of course, if you're going to buy it at this bar, you'd have to have a stop under here at least, or at this bar, you'd probably have to have a stop way down here. So the overall risk is much greater. After you get a pullback, we got above the Stark band here at this point A, reverse back to that 20-period EMA, then you could use a stop under this low right here with much more safety and a lower overall risk, which is, ideally. Obviously, not all trades are going to work out. And what you have to avoid, is the big hits. When I went overseas for Dow Jones at banks, Bank of Qatar, etc., I'd look at their traders stuff, and for the year, and it's invariably, and I think we all would admit that any year you look at your trading results, if if there were about 4 or 5 trades you cut out for the time period, it would be a dramatic improvement in your bottom line. Well, that was also the case in professional traders. That have some great ideas for 85% of the time, but if they came up with one stinker trade, it wouldn't look so good, at the year-end review. So, another typical thing. So this time, instead of the pullback here from the above the Stark band, we just got a little consolidation. Same thing in terms of risk, So we got three bars down. You could say, well, okay, I could use a stop under here or here. Was much more managed. We can get very volatile, it's picking a stop like Amazon. It went from, must have been another earnings. So it went from, over 1,000 down to 925, and there's a daily chart just in a couple of day period. It also becomes quite valuable to use this sort of analysis on market averages, because they can tell you when the market is in an extreme, either up or down. We've had a lot of extremes going back, 2018 or so, that have, determined, some pretty dramatic changes. A lot of people changed their portfolio at the wrong time and, often regretted it. So 2018, this is the NASDAQ 100, the same Stark bands you can see in early 2018. Those of you who may not have been trading then, 2017, they do those rather stupid, in my opinion, surveys of all the strategists from the big Wall Street banks, and they tell you where they think the market's going to end. I think this year they think it's going to end, about 100 points above where we are, like 40.78. But typically, it's a fool's game as far as I'm concerned, because even you're using technical analysis and no fundamentals, you can say, well, okay, the rally's over in October. The year-to-year thing is a very tough, line to hold to. And conversely, most of them don't do very well. But in any case, they were very bearish in 2017. And of course, the market just went through the roof. So 2018, they all became quite bullish. I mean, I'll talk about a little later, the AAI investor sentiment, the bullish percentage, I think at this bar here was about 55% bullish. And pretty much, everyone was looking for a 12 to 15% return in 2018 in the S&P. So bam, right out of the gate, we just climbed above the Stark band, above, till we got to the early part of February, and we got this huge downdraft. At the end of the year, we also got another downdraft. And as well, look, I mean, if you read the press, you would never be in the market, because it's like the start of a new recession. There was one trader, well-known trader, that was on CNBC, I think, at the day of the low here, and said we're starting a new bear market. So you can see a lot of different, 2-year period, and you can see we'll talk about early 2020. We had a similar sort of phenomenon going on in early 2020. In a trading range market, they can also be, if you're, if an option trader or you're a short-term trader, if you think you have a trading range, the Stark bands can help put your entry on at, obviously if you're buying put options, you want to buy them on strength when the market is higher, and you have some idea of where it's going to peak out. So obviously, 90% of the price activity is 0.3, could have been a good put buying opportunity. 0.4 could have been a good call buying opportunity. We'll show you, talk about a method in the AD line to tell you when such a rally is likely. But essentially, the Qs were in a trading range for all this period, and then started to change here. The OBV here, we won't talk about this time, but maybe next time. One of my favorite technical tools, and developed by Joe Granville. So it was pretty much, went from positive to negative to started to turn positive by the end of December here, which was a precursor, to a breakout of that range. And of course, then you can use the measuring techniques of a breakout from, roughly 112 to say 120. So, 128 was a minimum target, which we did hit in early February of that year. So it gives you a good clue as to what the range is for a given market. So early 2018, we talked about the sentiment. So here's what this is a toss chart using bands. One of my former students, now colleague, successful businessman and had his own professional career. Turned out he didn't know anything about technical analysis, and we worked for about 2 or 3 years together. Turned out he was also a very good programmer. So he programmed a lot of the stuff I taught him into TOS, and I'll show you some of his tricks too. But this is a really nice one. So these little these little yellow boxes show when they're above the closing above the Stark band, a weekly Stark band. So you can see right up in early 2018, bam, 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 we're up above them on a considerable basis, before that sharp drop into the early part of February. Another thing he did was take my 20-period exponential moving average, and so it's blue when it's rising, it's yellow when it's falling. So it just gives you a quick way to look at, what state of market is in. So, for example, in that decline, we'll talk about a little bit more in 2018, it was clearly declining. So you expect rallies to fail at that area, which they did for the entire quarter. In my headline, for my Forbes contribution, February 3rd, at that point, we said, is the stock market now on thin ice? If you're interested in seeing, you can just, Sherry's talking about Google before I came online, Forbes at Tom Aspray. You'll come up with this link and it'll take you to the archive. If you suffer from insomnia, I guarantee you I'm better than NyQuil. And you can see pretty much any I think there's like 1,600, or I don't even know how many articles are up there, but you pick a time and place, and if you know what you were thinking about the market, you can see what I thought and whether that turned out to be right or wrong. So one of the type of analysis I do and was in this particular time frame was to look at in 2020 where the NASDAQ 100 was in relation to its Stark band. So, the end of 2019, high of 80.81, 88.11, it's right at the Stark band. Early next week, 88.73, 88.79. Next week was not 110 of 2029, it was 110 of 2020. We were at 904, and we were above the weekly Stark band. This next week, the reading was 91.76, also above the Stark band. So in that period, as we got into the end of January, there's a little pullback, but it was screaming that this market was really, historically overbought. What's what I called it. I mean, I'd have, I was getting people calling up, well, I don't need to know about technical analysis because it's just a buy and hold, and it's only going to go higher, which is sort of analogous to the 29 crash, the cabbie being the expert analyst. Doesn't generally work. So you can see we're just moving above that weekly Stark band for a number of weeks until, unfortunately, the reality of COVID hit the markets, and we got a bunch of sharp drops down here. You can see below, and down in, but well below the Stark bands. So, as I said, obviously we were down below. We got a little bounce. I mean, actually, we made it up to 220 from, so it was a 10% bounce right within this week, but didn't change the trend. And of course, the 20-week moving average was also declining. So that was was a sign that, the decline was not over yet. So this is another chart from the middle of February, just before the market peaked out. So I feature this chart of Microsoft and all these stocks. So let's look at Tesla. Closed in January at 646. Half a month later, it was up 24%. Okay, it's, unfortunately, we all suffer from the fear and greed, and the greed I think is almost harder to spell. I talked to you look at a client who's in Tesla and it's at $800, and they don't want to take profits or anything, and you have them look at the options, and you see that the 850 call for say April is trading at $50. So I mean that means that if you bought that call, stock trading at 800, 850 call was 50, your break-even price is 900. That's pie in the sky sort of stuff. That's not not realistic. Well above the monthly Stark band. Apple was also right above the Stark band, as was Microsoft. This is the chart of Microsoft, shows you from that time period, 2/14/20, 3 weeks sharply above it. That was not a good sign. The technical tools, we will touch on in today's presentation. Relative performance, measures whether a stock or an ETF is leading or lagging in the S&P. So, in a bull market, you want to be in those stocks that are leading the S&P, not lagging it. And the on-balance volume developed by Joe Granville, my favorite volume toy that my colleague Jerry A has come up with some modifications that I think are probably superior. They weren't showing you any, any divergences or anything, but they were extended. On the right hand, you can see where that last bar was when my chart from in the Forbes post was taken. You can see what happened the next 6 weeks. It was just straight down. It went from above the Stark band down to the lower Stark band. And down here, you can see the relative performance. It actually, the relative performance doesn't tell you the direction. So it was still rising because, Microsoft wasn't dropping as much as the S&P. Another high risk situation, appeared in late 22. In late 21, early 22. This is again is the Qs. Right into September, we got a nice, pullback here to the Stark band. So low risk buy, high risk sell. We can move right back up. I guess it was 1, 2, 3, 4, 5 weeks later, we were back up above the upper Stark bands. So what I do is each week is I even Yahoo has Stark bands, so you can, I have an Excel spreadsheet that I use for my clients. I put in those weekly bands so I know where they're at, going into the next week. So we had 3 weeks above, and then, started to crack. So, all the way down, we got below the Stark band a couple of times, another one of those sharp rallies, got even lower, back above, up to 370, back down to 280 and, onward. So where you are in that scheme. So if you're thinking about buying and you're right in here, you're quite close. You can look at calculate the percentage difference between where the market is in a Stark band, and that tells you that the risk is high on the long side, not high on the short side. Conversely, down here, it's pretty close to the Stark minus band, so the risk is more favorable if you're looking at a long position than if you're looking at a short position. You can see that, right in the early part of this year, we moved above, the weekly Stark band in January before the market started to correct. Similar situation you saw in the SPY, both before the high. Of course, the SPY, made its high, in the early part of January. And then, a similar sort of phenomenon. You do get rallies above the 20 period, but this one got up to just about retraced almost 61.8% of this whole decline before it reversed back downwards. But similarly, oversold, 3-week bounce, but look at the moving average. It's the slope there says, no, I'm not buying up around in here because you're too close to that. And, takes on in October, we got back, below the Stark bands, a good spot. Well, in addition to, looking at the Stark bands, there are other tools that I use to help determine the weight of the evidence. So this is stock charts. You can see the purple lines here are a representation of Stark bands. Keltner channels, you might be familiar with. It was developed as a commodity trading, a breakout system in the late 70s, I believe, but they use a different period. So if you want to get them to close to Stark band readings, you use a 6-period moving average, 2 times the average true range, and to calculate the average true range over 15 periods. So you have to change those numbers. You can see right up in here if you're setting it up on stock charts. And I think I have a video on YouTube that talks about that. So down below here is another way to measure the market's health or weakness. This is the percentage of stocks in the S&P 500, in this case, the SPX A50, above the 50-day moving average. So, when it's low down here, it means that most stocks are under pressure and have declined. So the rubber band, if you will, is stretched on the downside. You can see right in here, we got close to the Keltner channel equivalent here. And, down here, we were at about 10% of the stocks were above, the S&P, and the S&P were above their 50-day moving average. So 10%, that means, roughly that 50 stocks were above it and 450 were down. So you like those odds, conversely, when you see a strong surge here, it's not necessarily bearish. You'll see most of these examples on this thing where the start from a very oversold to a very overbought is usually a sign of strength. And you can see we got up here and we kept moving up. You know, it wasn't until later in 2016 that, you know, we started to see a divergence here. You know, similar in October of 2016, we had another low risk. We got down into that 30 area, and you know, bam, we're off to the races. So in 2018, we just talked about, you know, overbought based on the Keltner channel analysis. Also high risk here above 80%. So if you're thinking the stock's going to go to the moon, and you find that, you know, 400 stocks in the S&P or more are above their 50 days, you know, there's a smaller universe of stocks to look at for new buying. And, you know, similarly in 2018, you know, we got very low reading here. And as I'll show you in a little bit, you also, you know, had a very, you know, we're at the Stark bands, and you know, less than 10% of the S&P stocks were above the 50-day moving average. I do regularly paste market updates on Twitter if you're interested, and also charts. So, you know, here's another NASDAQ 100, similar sort of thing. So, you know, you get this transition for, you know, 20% down here, and then, you know, back up to, you know, 80 to 90%, and you start to see these sort of divergences, which is kind of what we saw recently in January. And you say, okay, well, you know, you look at other pieces of evidence, advanced decline numbers, McClellan oscillator, volume, and you start to say, okay, the market's ready to pull back. So this was during that period when, you know, a bunch of trade tariffs, you know, which of course, you know, kicked the stage for this bottom in October. And a side note, that picture from the cliff in Ireland was taken right around in here. So I got back to the office just in time. So in addition, you know, sort of building, you know, the tools. And I should point out here that, you know, when I work with students, I don't, you know, they don't have to use only my indicators. It's not one way and only one way, but I'm receptive to what, you know, what you see. I remember ages ago, I wrote a article for Stocks and Commodities about the crossover called the directional movement oscillator. So you might be familiar with the plus DMI and the minus DMI. So looking at when the plus DMI moves above the minus DMI as a buy signal, and conversely when it drops below. And I wasn't recommended as a standalone tool, and I got some email from somebody in Copenhagen and how he used it to great success in the bond market. And I said, you have more confidence than I do, you know, because that wouldn't be enough for me to trade the bond futures, but apparently it was for him. So we have the risk analyzer here. This is based on the NYSE composite. It's the broadest measure of the stock market. It can be very valuable. It gives you a better view, in my mind, of the common stock. And for up till 2008, it was the only advanced decline line I followed because the data wasn't widely available. It has stocks, ETFs, bond funds, ADRs, a whole bunch, you know, like 23 to 2,800 issues in that market. So below here we have, you know, how many are above the 50-day. Once again, the same sort of low levels here noted on the chart, you know, and, you know, sometimes you get this sort of, you know, you get oversold, you get work off back to the overbought, back to the oversold level. And below this, I have the NYSE advanced decline line. So this advanced decline line measures all the issues in the NYSE index. And there's another stocks only. We'll talk about it later. So you can see, and above this in blue is this 21 period exponential moving average. So that's one of the way I rate them, as well as the trend of the AD line. I look at the crossovers here. So, you know, these dashed line represent crossovers that coincided with, you know, readings, oversold readings from the breadth analysis above the 50-day often work well together. So that's sort of the weight of the evidence. They both were saying, okay, this is a reason to be long, and the risk is manageable. So I've been doing this for a long time. There's just some of the, you know, gives you an idea of some of the, you know, the various, you know, bull and bear cycles here up through 2013, you know, 49%, you know, and this was a growth decline, similar to what we saw last year. This was a value rally, And, because the banks were all the ones that most of the banks actually and the home builders topped out around here. And, the other stocks kept the market going. And there were clear divergences at that high. And, off the, low here, we'll show you a little graphically. In 2009, the monthly AD lines flipped back to positive, and that was a very clear signal. These pullbacks here look pretty ugly on this chart, but they were supported by no negative signals from the monthly AD lines. So here's a chart of it going to 2003, the whole cycle up. You can kind of see here that the AD line peaked here, peaked there. If you aren't familiar with divergence analysis, it's pretty important. I'll talk about it a lot, but if you really don't understand it, one of the things I typically do with students I work with, like Jerry A. long time, I send a bunch of charts and say, analyze this for me. Where's the market going to go now? And then he marks them up, scans them back to me, and we talk about them in our next session. So you can see that all the way through these pullbacks here, this is when they downgraded U.S. debt, and the monthly AD line stayed positive. So what do you see when you see a correction? Well, this goes back to 87, a real classic one. The S&P 500, NYSE AD line, higher highs, okay, up to 0.1, a pullback, and then up to 0.2, new high in price, lower high in the AD line. So I look at trend lines, which was in force. We pretty much stayed below its moving average. We had a little pop here, and then turned back to positive in June. Another run to the upside into August. And even though prices were significantly higher, the AD lines were lower. Another short-term divergence as well as the longer-term divergence. So now we had the daily warning and the weekly warning in August and broke down here. And you can see market really gave you plenty of warnings to get out before, of course, the well-documented 87 plunge. Oops. And so for the last major bear market in 2007, 2008, you may have a little trouble. So the AD line peaked here in June. We had a nice rally up in July, and then a very sharp correction. If you look back, often interesting, if you're combining, or testing something out, you could probably search, August 15th of 2007 financial news, and you'll probably see the most dire forecast. Of course, a bunch of the mortgage-backed hedge funds had blown up around in here, got very oversold, well below the moving average. In fact, the decline in the AD line at that point was a tell that it would be very hard for the AD line to make it back to these highs on another rally. And of course, we didn't in early October. Another further divergence, pretty much negative. We had a bear market rally from March until May, and then, it got even uglier. Once again, the 20-week EMA, it did a really good job of, this little rally we had during the summer of getting out. So here's one I think I follow every day. This actually was from this week. This were the numbers, before the Fed, 124 on Wednesday. The advanced decline numbers were negative, so 1120 up, 851 down. High lows were negative, and the NASDAQ were also negative. So this is something I moderate during the day. Option traders who've taken my course will often see, oftentimes you'll see an imbalance. So you'll see like really strong or really weak AD numbers, and the prices won't be reacting, but they do in the afternoon, which, of course they did in this particular day. There's the link for it, or, if you have any questions during about the presentation that I don't handle in the Q&A, Tom at Viper Report, and I'll get back to you. So here's the kind of headline. So we're into, 2016 was a real classic example. Bloomberg, are we headed for a recession? A recession worse than 2008 is coming. This was like January 15th on CNBC. The next month, this is one of my contributions to Forbes, was, the Baron Rothschild, time to buy when there's blood in the streets. And there were signs. Everyone I was talking to was pretty bearish. And, all the talking heads were bearish. And the technicals were to give you a much different impression. So this is a chart from the article. You can see this drop right here was really extreme. I'll show you another chart later that shows you the the bullish percent based on the AAI survey at that level. We reached the lowest level since 2005. We got to rally back up to the 20-day. So anytime you see this sort of a stretch, and I calculate the gap between the moving average and that. So I don't know what this was. Let's see, we probably could figure it out. So it was probably 970 to 70. So it must have been probably about 7 or 8% gap in there. That's really stretched. So you're going to get a rebound. At that point, you don't know whether this rebound is going to break to new lows or not. So you're watching it, and you got this gap down and lower close. The next day was up, and the NYSE composite AD line started to turn higher. So I was watching for it to move above this moving average, the downtrend, and then this downtrend. McClellan oscillator is a short-term advanced decline indicator that often doesn't tell you a lot, but sometimes it gives you very valuable in corrections in. So it was showing a very strong divergence here, which was another reason to be bullish, particularly since everyone was negative. So this is how another chart, of showing you that decline, 2081 down to, 200 points, more over 200 points, in 15 days. No wonder everyone was a little spooked. We got back down here. The S&P 500 AD line did not make a new low. So we had a bullish divergence here, slightly lower low in prices, higher low in the AD line, overcame resistance at this arrow, and then the downtrend, and was soon, moving to new highs by March and April. Pretty much no one was really very bullish for months after, that low. Earnings have been negative. I don't pay much attention to earnings other than when they've been negative for that long and everyone expecting them to get, the fact set guys who put out their, they were really negative on them for quite some time. So that was a good sign. And here's what some of the other technicals look like. So, here we have S&P, the cash. You can see, 1812.29, 1810. So the new lows. One thing I really like about stock charts is the fact they give you the pricing. It is very handy, because when I'm looking through 70 stocks as part of my weekend thing, I do it through stock charts, and I can see, that where the last swing low was, and I can immediately calculate. If you were thinking about buying right here for at 2064, that last low is 2040. So you're risking 20 points on a $2,000 tab. That's a reasonable stop if you have other reasons. So we have the AD line here, similar formation as the one I just showed you. And down below here, this is the plot of the bullish percent. So this was that 17.9. I couldn't believe it when I went back into my database and found all through the bear market of 2007, 2008, it never got that low. So it moved up to 30%. Which was up typical that in a rebound, we flips around, got right back down to 19% at this low. So that was all set up, for which was the best buying opportunity in 2 or 3 years. As it turned out, it was a buying opportunity. You didn't know that. Many people don't use the advanced decline analysis. I found this, which I really love the cartoon. And at this particular point, I crossed out the guy's name, but I'm not in there to point figures to anyone, but I just thought most people don't use it or don't use it the way I use it. And, saying that it's lying to you because it was looking too positive. Well, this is that when that article came out, and you can see the AD line, we had a little pullback here, but it was pretty much, a very strong move to the upside. This was April. This was the Brexit pullback, which was, looking at the AD line analysis was a non-event. So typically what you look for, and so then again, you look at the length of a divergence. This is, a fairly classic example in the fall of 2018, higher highs in the NYSE composite, but and in the AD line all the way up. But then, on September, I think it was 21st, 24th, lower high here. So this divergence plus forming a doji up here, and at the Stark bands, we're saying like, uh-oh, something's changing. We dropped down to early in the month, and then, they sort of pulled the plug on the market for the next 3 months. And, you can see that divergence. Here's in the stock charts view, same sort of behavior. The lower highs in the NYSE all. This is the stocks only. It didn't form a divergence. It made it back to that high, but then also broke its support, confirming, as of October 2nd, that was a pretty sick looking market. So by the end of the year, I mean, it was really sentiment was very extreme, very negative, as this CNBC headline indicates. But once again, the technicals were saying a different picture, so we were about 45% bullish at the start of October, 45.7. By December 10th, 2 weeks before the low, it was down to 20%. And you can see the AD line turned around here, started to move higher. And actually, by the time you got into February, you can see that the AD line was making a new high, which was really a strong signal. And here it gives you just the AD line. I also run the Keltner, or in this, or the Stark band modifications over the AD line. You can see right here in December, below the lower band here, pretty interesting. And, and still a very positive trend there. So, if you're interested in AD line analysis, I've written a fair amount about it. This was sort of a classic in 2015 when, the NASDAQ 100 surged to a new high. Pretty much all the other markets look weak throughout I was writing an article I released every week for Forbes at that point, and it was sort of like a broken record. It said, market's still negative. Wait till we get, low sentiment readings, AD line positives, and you can see we surged to a new high and then in the Qs. But look what the AD line, it peaked up in May with everything else and just formed this series of lower highs. And often they will hit that downtrend. And then, of course, this was 1,000 point. We were down 1,000 points in the Dow this day on the open, 20 minutes into it. So it was a pretty, and that selling, as we pointed out just briefly, it carried over into 2016. So other reasons the AD line analysis, can be beneficial is that you can look at, extremes and give you clues as to what's going on, and so in reviewing, the advanced decline line is just a cumulative total of the advances minus declines, like I showed you in that table from the Wall Street Journal. So typically what you see is a transition from a bull market where there are many more stocks leading to a bear market, when more stocks start to decline. That's what we saw in October of 2007. That's what we saw in early 2022. So, this was going back to 2019. You look at the imbalance, a high percentage of declining issues, like 90% of the stocks were down here. That's a sign that you're going to get a snapback rally, particularly when you're at the Stark bands. So, option traders look, you can see that, a call option up here, 5 days later, it's probably lost 50% of its value, if not more. And, you get these quick moves back, and this still does work. These were a bunch of new tariffs, and we had all these moves. And then in October, we got another series. And at that point, the daily AD lines, were also turning higher. One last thing on this, on the sentiment and the AD stuff, and here we, in 2020, you can see I like the way the pivots work on stock charts too. So you can see this, it hit the R2 right near the highs in February 2020, before everything collapsed. Sentiment had already peaked out, but was still pretty high at 41%. It peaked out early in 2020. And, you can see the volume here was actually, the volume on the last move up, was not nearly as strong, and certainly wasn't as strong as it was that fall. So this is just another shot of a correction. Once again, to kind of go over the indicators if you're confused. So basically, the Stark bands here, plus and minus. So, above towards the upper band, high risk buy, low risk sell. Near the lower band, low risk buy, high risk sell. And then the AD line, another classic divergence here. This was the market scare over the Ebola in 2014. So again, 10%. So, most people won't ride those out, So when you start to see, a divergence and then the AD line drops below its moving average, that's when I pull in, my trading long positions and don't give them much room to go against me. And that protects you because you don't know whether you're going to see a 4% pullback really, or a 10% pullback, which makes a big difference. You can maybe ride out a 4% if you still have a nice profit in the position. But once again, the risk reward parameters, do not favor probably riding out a 10% correction. And so here's how it, what the AD line looks like for the NASDAQ 100, and this is actually, real time. So I think I put this one out of order, but you can see from 2019, it was pretty much was above that uptrend until early in 22. And here's the resistance level. Looking at the numbers right as of Thursday's close, we're just barely above its moving average. I mean, barely, like 2 or 3. So market was looking weak when I looked at it before I came online. And so you need a strong number today to make that positive. The last part of the presentation I'd like to talk about is in Stark band, is in pivot analysis, how you can use them with the Stark bands. So once again, this is pivot levels. So if you're familiar with pivot levels, the formula is fairly straightforward. You can find online, but essentially it determines the pivot. Like for example, in July of 22, is based on the price activity of June. Now, what I found is it gives you a number that's often different than other measures you would use. For example, in 22, the 20-period EMA was quite close to the pivot here in blue. The red line is the R1, green is the S1. And so, there were signs here. You kind of broke this downtrend. You got pulled back right below the 20-day EMA, which is rising. Okay, so once again, a favorable risk entry with a stop under here, and you shoot up in the next month. You get up to the pivot, after you've hit the Stark band. So, what I do is I take note about whether we're near, close, or at, or above, or below the Stark bands, and then look at the pivot levels. So we got right up to the R1 in August before the market started to turn over. Rates started to tick higher, and pretty much the entire decline, we bait it briefly above the pivot in October, but then another plunge. And, the 20-day only turned up for about 1 bar, I think, and then another good short. So, if you're looking at this market like it down here, you're near the lower Stark band, the S1 support, high risk area to be, buying puts or selling. Get back up here, a good area, a low risk area to be buying puts, a high risk area to be buying calls. And if you look at this on a weekly chart with the same levels in there, it even, more clearly shows you how these pivot levels, can be maintained. And look at with the 20-week EMA, it came right up to the pivot as well as a 20-week. And so, if you see this sort of pattern, it's not something you want to buy. And you can see, usually what it only takes is one big up week and think, okay, things have turned, but the slope here said, no, that's not a trade to take. So I use these in conjunction, with my technical indicators to get in and out of trades. So there's a trade from last June, Apple, a bellwether. So we hit the pivot here in blue, came down. I didn't draw. There's the S2 was probably down in here, So each one you have an R1. There've been an R2 up here, an S2 down here. Got down to the Stark band, 3-day bounce, right back to the S1, another push. We started off into June. We got up to the pivot here. Anytime, that you see this sort of thing, I've been an example. I don't know if I have a chart of it, but in the housing ETF, and pretty much hadn't done a lot, frankly, and it's been bumping into its pivot for almost the entire month. And so I finally cut out the last position this week because it was just, I normally don't give, if I'm looking to short something, I see this sort of thing, and I'm looking to be a seller, not a buyer. We made it down in to the S1, and we get it down to the pivot. So then we started turning higher. Below here, we have the relative performance. So this is just the ratio of Apple stock price to the S&P 500. So what that tells you, and when it's falling, that means that Apple is dropping faster than the SPY. When it's rallying, it tells you SPY is moving, is gaining price faster than the S&P. So as I said before, you really want to be in strong stocks, market-leading stocks based on the RS analysis on the long side, and on the short side, you want to be in stocks that are acting weaker. So, we had a clear level of resistance, that was overcome, on this rally up, got close to the Stark band. So not, not a really good entry point. Besides, your stop would have had to been here or here. And then you get that 4-day pullback right close to the S1. And, the RS stays positive. Down below here is the on-balance volume. It broken out, right here, and it pulled right back to its moving average, which is typically a bullish setup. He had a nice run to the upside. So, in August, we hit, I think we got out of the first position around 165, and then the other one probably a couple of days after the higher, right around 170, because once again, we moved above, the R1, came close to the stochastic RSI, or the relative performance rather, stayed positive, but look at the OBV. It formed a divergence. Lower highs here, higher highs in price. That's a warning that, the volume, you can see that what happened, if you look at the individual bars, these last few days on the upside here, lower volume, and then once you started to decline, the volume increased. One last little trick here that I really like is a quality analysis, and it shows you just that you can measure the downside target, and I probably won't have time to do it justice, but you look at a decline like from A to B and think, well, what are my downside targets from C? And if, this decline, is going to be equal to this decline, takes you down to 122.43 for Apple, which was pretty close. Looks like I'm kind of getting close to my end here. So let's see a couple more examples of the Stark bands and the pivots, both using the SPX. You can see in August, that, was given the same sort of warnings as we were seeing in Amazon. Stark bands, R1, here was the R2 we never made it to, early September bounce, you're crawling. So you see 3 or 4 days, if you're in a put, that's not, okay, like, you're not letting it go, you're not giving up those profits. Okay, and this chart is as of the 22nd. So as of Wednesday, reversal. We just hit the pivot on Wednesday. 38.77 is the support level. And, of course, the financial stocks here, looking pretty sick, and still look sick. You get that sort of break on long volume. I think it's a fool's thing to be buying a snap unless you're a really experienced short-term trader and you're scalping like weekly options and willing to get out of them the same day, because it's going to be that kind of market probably. And hopefully another shoe won't drop. Based the current AD line analysis, this is as of yesterday's close, still negative. We need up to the up Stark band here. The 80 line peaked out, and has been negative. So it popped back above its moving average a couple of times, but it didn't do that this week. And look at the slope of the moving average, and suggests there's going to be a time. So, right in here, that was too early, till you give it room. So here's the support level. The first sign of a turn will be a move above this moving average and then above this downtrend. The Qs obviously look much better. So the Qs also a bunch of tails here. So, that's a support level right in here. AD line looks better on a daily basis. It closed positive as of Thursday's close. Really needs to get above these peaks. And, a pullback into this area might look interesting. At the bottom of here, we can see what's been happening with the relative performance, and that's why the growth stocks have done so well, is that, it started leading the S&P again in January, and it still looks really strong. So it's a market leader. From October till December, it was the Dow that was leading. Now it's the Qs. And one last AD chart here. We'll show you, this is my panel I run on stock charts. So the S&P 500 AD line, similar, we just talked. Stocks only, also negative. And the all AD line, even worse, it's right below, once you remember, this was resistance when we moved through it, at the start of the year. Now it was support, broke support, so now it's back to resistance here. Same resistance here. So, you're trying to see if we're going to break below these lows. If you do that, you're probably going to see heavier selling. And the last thing, I had to show in Jerry's nice creations is futures trading using the S&P futures, and pretty amazing. I won't have time today to go in, but I'll probably post something on the Viper report. But it basically works on 260-minute. The red arrows, so it went, back to the short side on Thursday's bounce, and it was pretty negative when this was taken about 5 a.m. And a couple of interesting, his volume indicator, and he took George Lane's stochastic apart and built this. So if you're interested in learning more about technical analysis, and particularly for me, if you found this beneficial and hopefully not too overwhelming, I have a special offer to attendees, and that's for a one-on-one training that, typically a 90-minute, but I'm not a psychiatrist, so I don't watch the clock that closely. So, and basically, what we do is, if you're interested in this, you can read about it. Here's the link at the bottom, and basically it's a one-time fee of $199. If you sign up and pay by PayPal, then my office will set up a phone call with you. I'll get on the phone with you, however long it takes, 10, 15 minutes, and we'll see where you're coming from. Some people, I had a nice lady from Australia 8 months ago that, she was really, I didn't think she'd benefit from me. So I said, hey, just refund your money. That's fine. Maybe come back, but otherwise we'll develop a plan for your session. And then after the session will be follow up through email and charts to see if you've gotten that. So typical people ask me to review their last trades, look at, intro to the AD line analysis, setting up indicators and stock charts, an introductory course to pivots, or analyze your portfolio. So, the topic is pretty much up to you, and I'll put together a plan for it. So, I've been lucky enough to work with a bunch of great technicians. John Murphy and Martin Prinks wrote these nice comments, and I took my first overseas trip teaching technical analysis with the two of them in 1986, and Australia and Singapore and Hong Kong, and it was quite an enjoyable trip and an interesting enlightenment to how traders work overseas. Maybe more on that next time. So let's see if we can see what questions we might have. Show answered question. Do you have a list of speakers? Okay, that's yes. Okay. Do you have a list of speakers? No. Gee, no questions.
Carlos says, yeah, well, there's you probably got to scroll all the way to the bottom. I usually set it so that they scroll newest to oldest. And
Okay.
Carlos said, interesting presentation, good stuff. And I did post the link to the questions to everybody in the audience as well as in the chat.
Okay, great.
So at this point, why don't you do me a favor and think of a number between 1 and 200. Don't say it yet, though.
All right.
Because you have a prize that you've donated. Let's see, 6 months to the Viper Hot Stocks report for free.
Right.
Is that the right thing?
Mm-hmm.
Awesome. Okay, so have you got your number?
I've got my number.
All right, everybody. Type in a number between 1 and 200 just once.
Just once. 77.
Was that your number?
That's my number.
Oh my, Jerome, you got it right off the get-go. So
he's probably a good trader.
Yeah, there you go. He's got the ESP going on. Cool.
Right.
Okay, Jerome, I'm going to give you my email address, and I want you to email me, and then I'm going to connect you and Thomas so that you can get set up for your report. All right.
You'll
Good
get
deal.
reports over the weekend starting, Jerome. So look forward to working with you.
Perfect. All right. Did I give it to Jerome? Who did I to? Well, Jerome, I'm going to do it again. For some reason, it didn't go. All right. Well, I thank you so much for coming and being on with us today, Thomas. I really appreciate it.
Well, thank you very much, Jerry, for having me. And if people have questions afterwards that they didn't come up with, Tom at Viper Report, and I'll get back to you eventually.
All right. Perfectly.
All
All
right. You have
right.
a great
Thank
day.
you so much.
Get
Have a
better.
good day.
All right. You too.
Bye-bye now.